George Pearkes, he's Bespoke Analyst. He's saying that there's a lot of noise today. Some of it does signal global risks. And Point View Wealth Management President and Chief Investment Strategist David Dietze. David, to you first, are you buying right now? I mean, we've got the Dow down 350. You could argue this is a disaster, or things are cheaper today than they were on Thursday.
Hey, Liz, one day does not a trend make. The Chinese story, this is a story that's been developing now for close to a year. We had perfect storm here with the drop in the yuan, the drop in the Chinese stock market, which is exacerbated by those silly controls and bans they put on, and one data point that was a little below the expectations. This is the time to look at the companies that are well managed, great franchises, returning money to shareholders, and make your investments now.
The perennial optimist. But George, and I like David's thoughts, because I think you got to do your homework and pick some great names. Look, Lululemon is up today, but you believe that this could portend a worse global slowdown?
Sorry, was that directed at me, Liz?
Yeah, George Pearkes. You there?
I am. I think that there's a lot of concern right now over the global economy, and rightfully so. And there are reasons to be nervous around how far China's growth is going to fall down from the accelerated trend it was on. But I do think that the market reaction we saw overnight in Shanghai and some of the market reactions we've seen in Europe and in the U.S. equity indices just don't sort of jive with that story. There are risks towards growth globally, but we continue to see an expanding U.S. economy, a very steady U.S. consumer, and a lot of demand impulses that didn't exist 2 or 3 years ago that are sort of continuing to pile on. So our view is much more modest than sort of, we're poised for a major global slowdown.
Liz, I just want to make this one point, and then I got to go. But I want to say this, and maybe I'm wrong on this, and I hate predicting gloom and doom, because it's never as bad and it's never as good, except for in 2008. It was the only time it was really bad, when you knew it was bad. But a lot of these GDP growth estimates that people throw out, listen, I'm not saying they're wrong. I'm just saying they're not forward-looking. They're backward-looking. They're almost static in the sense that they take into account what's happening now. And what they should be doing is taking into account what could happen in the future. And if what's going on in China actually materializes, metastasizes into something worse, I should say, those GDP numbers are going to come down quickly, and that will have an impact on stocks, particularly major averages. I mean, it's just the way the world works. I'm not saying it's going to happen, but if you're an investor, you got to remember these GDP forecasts that these guys throw out, they're almost backward-looking. They're not taking into account the possibility, the real possibility of a big slowdown.
Charlie, since I threw that one out there, let me come back with you and just clarify one thing on the outlook. It is forward-looking. If you look at domestic demand in the U.S., consumer spending and business investment, it's growing at better than 3%. It's growing at better than a 3% rate right now.
But it might not grow.
And we have the trade deficit. No, well, it might not grow. Well, I mean, in any forecast, you're going to have to forecast it one way or the other way.
We don't know what's going to. I know and listen, I'm not debating you that you're not doing your job right. This is very difficult. My only point is to alert investors one thing. A lot of these estimates are based on what's happening now, very static, and you don't know what's going to happen. I mean, this recovery, there's been times when it looked like we were growing at 5%, where it would ratchet back down to 1% again. Hence, we got an average of 2%. So just remember, this is a crazy economy.
I don't know that we've ever broken out.
Charlie's absolutely right here. Yeah. But the real wild card is, what's the Fed's response? What are they doing in terms of 2 to 4 hikes in 2016, given what Charlie's talking about? And I think that what investors have to be looking at is the Fed speak. How quickly is it going to be that we're going to be hearing some of the talking Fed heads talk about a little bit slower pace? And I think that's what we've got to be looking for.
Nobody knows what's going to happen, except that we do know that great companies that go through bad times, George, are good opportunities for an investor who has a little bit of fortitude, right?
Absolutely. And I mean, that's the whole point of investing, right? You're trying to make a return by taking risk. We could have an asteroid fall tomorrow and wipe out the human race. No one expects that to happen.
Well,
but of course it's possible.
China is like not exactly an asteroid.
The forward-looking estimates, as Charlie was pointing out, absolutely there are risks to every estimate that's out there. But people need to remember that the American economy is about the American economy overall. I mean, we are not as exposed as almost any other major global economy.
Yeah, but you could argue,
especially to Chinese financial markets. So yeah, absolutely. There are risks from China. There are risks from the emerging world more generally. There are risks everywhere. That's what investors need to understand when they try and make a return in the market. There's no such thing as a risk-free return.
Charlie, hold on. I do think that it's important. I think it's important to say that this is the 10th month in a row that China's ISM showed a fall. So how anybody could be surprised by this, it could just be, and I guess, Mark, you might look into something like this and say, yeah, that's it. It could just simply be the malaise of going into the new year without a lot of clarity on where this economy goes.
Well, that's a big part of it. But on the other side, their services purchasing managers index hit its highest level in 18 months. And domestic demand in China seems to be holding up relatively well. The CACSM index, which came out, reflects what's going on with a lot of their exporters. And their export demand is weakened because the global economy, not just in China, but emerging markets around the world, Brazil, Russia, they've all slowed. And so that certainly has imported their exporters. But domestic demand in China is picked up a little bit. And I got to tell you that the sell-off in China seems to have been more technical than triggered just by that ISM report.
Right.
There is a moratorium on sales of lost positions that expires at the end of this week.
Friday.
And so some folks may have been wanting to get out of the way.